So you've been saving up for years to buy that dream home of yours. You get to the notary, you give your down payment, and you leave with the keys and the deed. You're super happy, but then what? How are you going to buy furniture? How are you going to buy paintings? How are you going to make it your own? Well, what if I told you that there's a type of mortgage that can give you your cash back? That's right. It's a cashback mortgage. How does it work? Are you going to get screwed on the interest rate? Let's find out. My name is David Pons. I'm a mortgage broker right here in Montreal, Quebec. And on these videos, we look at mortgages and all their quirks and features, as well as a little bit of personal finance and credit. Also, don't forget to like and subscribe, press that bell icon so you never miss any of these fascinating videos. So what is a cashback mortgage? Well, it's literally what the name says. It's a mortgage that gives you your cash back. You know how it works. You normally go to the notary with your down payment, the bank lends you the rest. The seller gets his money, you get the house. Everybody's happy. But you lost your down payment. Well, you didn't lose it. It's in your house now. But in a cashback mortgage, you can actually get some money back. You choose what percentage. Usually it's about 5%. It can be more, it can be less. If you heard about this before, you might have also heard from some people, oh, this is a terrible idea. The interest rate is going to get jacked up so much, you're going to end up paying so much more than the money you got. Is this true? Well, let's find out. Let's first of all see what exactly it is. On top of lending you the money to buy the house, the bank lends you an extra bit of money, the cash back. Now, it doesn't work like a regular loan. You don't make monthly payments on that where the capital goes down and you pay a little bit of interest. But the bank does want to get its money back, right? I mean, they're not just giving it to you. And the way that they do that is by adjusting the interest rate on the whole mortgage. Usually what they do is they increase it by 1% for every 5% of cash back that you get. So if you get 5% cash back, your interest rate will go up by 1%. So then how do you find out if this is a good deal or not? Well, one way to do it, and I think the right way to do it, is to find out the difference in interest that you've paid between the two different types of loans. So let's look at some numbers. Let's do a few scenarios, okay? Now, let's imagine a $300,000 loan. If you take 5% cash back, this means you got $15,000 back after you left the notary, right? So what happens to the interest rate? Well, it's August 2023 and interest rates are at an all-time high. So right now, if you get a $300,000 mortgage, with 5% down, the maximum you can amortize, so the longest amount of time that you're allowed to take to pay that loan back is 25 years. And the interest rate looks like 6.19%. That's right. So a $300,000 mortgage at 6.19 over 25 years would cost you $1,953.43 per month. More importantly than that though, how much are you going to pay in interest over the 5-year term? It's important that we talk about a 5-year term because that's how cashback works. It's on a 5-year term. So the interest that you're actually going to pay on that is $87,432. Let's just pause for a second and think about how much money the bank is making with their interest. $87,000 over 5 years. But of course it gets crazier if the interest rate goes up. So now let's look at the scenario where you've gotten $15,000 back, your cash back. The interest rate is now 1% higher. It's 7.19. But now your payment is $2,136 per month. So about $180 more per month. But where it gets really crazy is where you look at the interest that you've paid over the life of the term. It's $101,975. That is a lot of dollars to be paying in interest. But it doesn't matter. That's not really the point. The point is the difference between the two. How much more interest did you pay by that extra 1% in increase on the interest rate for the whole loan? Well, if you do one minus the other, it actually gives you a difference of $14,543. So that's right. You got $15,000 up front, and 5 years later, by jacking up the interest rate by 1%, you ended up paying $14,500 and bits more. Not even $15,000. So what does this mean? It actually means that you are not getting screwed by jacking up your interest rate. It means that you're not paying more than the amount you got. The bank makes its money back and a little bit less. So, is it a good idea to take the cash back? Well, I don't want to say that it's a good idea. I just want to say that it's not necessarily a bad idea. It depends on whether you need it. It depends on whether you can stomach the extra, payment, the increase in payment on the interest rate. And of course, you're going to be paying down your capital a little bit more slowly, which you can catch up when renewal comes up. That's not the end of the world. In terms of how much you're paying, you're not paying more than the money you got. As long as if you get 5% cash back, your interest rate shouldn't go up by much more than 1%. A few banks do this. CIBC does that. BMO does it. A few others do it. Always find out what the interest rate will be depending on the amount of cash back that you get. Now, There's a few things you need to know about the cashback. You can't use it as your down payment. You need to have your down payment saved up. You also can't use it to pay off debt. So if your file doesn't work because you have a lot of credit card debt and you think you can pay it off with the cashback and qualify, it won't work. You have to qualify with your income and every other metric, every other income ratio and credit, of course, satisfied before you get that money. And one last important point that you should know is that different banks handle prepayment penalties differently. This means that if you have to break your term 2.5 years in, 50% of the way in, some banks will require the cashback proportionally, others will require it fully. So for instance, CIBC, unless it's changed, but I don't think it has, will require you to pay back the entire amount that you got, even if you have a few weeks left on your term. Whereas BMO, well, they'll let you do it proportionally. You have half your term done, you want to, break it and go to another bank, that's fine. You only pay back half of the money that you got up front, which is fair. So that's how the cashback works. For more videos on mortgages, finance, and personal credit, tune in next time.